Okay, good afternoon, everybody. My name is Robert Duarte. I am Chief of Public Affairs and Communications with Assessor Jeffrey Prang, and I would like to welcome everybody to today's webinar. Today's webinar is Assessor's Resource Webinar, A Guide to Inheritance. And the goal of today's webinar is to go over Prop 19 and the implementations that are going to be affecting with Prop 19. A couple of housekeeping items before we begin. Just so that you all know, today's webinar is being recorded. It will be posted on the Assessor's website. We are also broadcasting live on Facebook on LAC Assessor. We also will be posting this on the Assessor's website. We'll be sending out a newsletter as well. We do understand that there are a lot of questions regarding Prop 19. We have accepted a few questions beforehand. A lot of those questions can be found on the assessor's website of assessor.lacounty.gov/prop19 under the FAQs, but we will also be addressing a few of those today. But I do ask that you submit your questions via the Q&A function at the bottom of your screen. We are going to be collecting them and we will then be answering them at a later date, hopefully by the beginning of next week, where we're going to be sending out a newsletter with the recording and with the answers to those questions. We will also ask, if you want, please email pio@assessor.lacounty.gov, and we will make sure that we'll get all those answers to the best of our ability. So we ask that you please submit questions that way, and we'll go ahead and be addressing them likewise. A huge disclaimer for today. Today, a reminder that the information provided is intended to provide general and summary information about Proposition 19. It is not intended to be a legal interpretation of official language or relied upon for any purpose, but is instead a presentation of summary information. Proposition 19 is a California state constitutional amendment. Additional legislation, regulations, and statewide guidance are expected to clarify its implementation. If there is a conflict between the information provided here and the proposition, or any legal authorities implementing or interpreting the proposition, the text of the proposition, and the other implementing or introspective authorities will prevail. We encourage you to consult an attorney for advice specific to your situation. We do have our moderator with us today, Meny Atias. Meny Atias is an immigrant from Israel. He is a real estate broker based out of Los Angeles. Meny owns multiple Keller Williams franchises in the Los Angeles area, and his daily objective is to assist real estate professionals in building thriving businesses. His personal attributes and professional experience allows him to coach agents with patience, guidance, and experience, encouraging them to develop skills necessary to navigate the ever-changing real estate industry. Meny is a certified recreational rescue scuba diver instructor and an Israeli Defense Force veteran. He is passionate about reading, hiking, and coffee, and Meny also serves as a member of the Assessor Advisory Council with Assessor Jeffrey Prang. So I'd now like to introduce Meny.
Thank you so much, Robert, for the introduction and for the opening. It's a great honor to be here, part of this group, and moderate this important session. As you remember, November 2020, just over 51% of voters in California supported Prop 19, which gave new property tax breaks and also applied a few other changes that we're here to learn. So what's important about this session today is to mainly to get some clarity about how Prop 19 works and to better understand the measure and how it affects the homeowner. I also believe that as realtors, there's quite a few realtors in this session today. We have a duty as we serve the public to know the ins and outs of such changes so we can better explain to our clients. And with that, we have some amazing speakers lined up for today. We'd love to introduce the first one, the chair of the California Board of Equalization, Antonio Vasquez. As chair of the California Board of Equalization, Antonio Vasquez represents the 3rd District, which includes most of Los Angeles County, all of Ventura County, and a portion of San Bernardino County. He was elected to the board in November 2018 as the first Latino ever elected to the BOE since its inception. Vasquez brings to the board over 20 years of business and government experience involving strategic and long-term planning, business development, and municipal and legislative advocacy. He is known as a tireless advocate for responsible growth and development, fiscal responsibility, public safety, affordable housing, open and responsive government, and education to improve the quality of life for all Californians. Please welcome Chair Vasquez.
Welcome. Thank you for those gracious remarks, opening remarks, and introduction. As was mentioned, I am the chair of the BOE, the Board of Equalization, which our duty as a board, as a chair, is to set policy for the 58 assessors. And later you'll be hearing from one of our assessors, actually one of the principal ones in the state of California, Mr. Jeff Prang, who represents the county of LA, which is one of the counties in my district. I really only have 3 assessors in my district, and that is Jeff Prang from LA County. Then I also have the assessor from Ventura and San Bernardino as well. Unlike my other colleagues, they have anywhere from 10 to 30 different counties because it's all broken up based on population in the state of California. But with that, I just wanted to thank my assessor for the invitation. I've been working with him the last couple of weeks on this issue since the passage of Prop 19, and I'm glad to hear that you're going to hear from some attorneys. And I'm glad there was a disclaimer earlier because the information we're going to share with you and discuss with you today by no means is a legal opinion or even an opinion that you can take as you decide your situation for many of those that may be looking to transfer a property or to sell a property or to either downsize or upsize your current home. And Prop 19 is definitely going to have some impacts on those folks. I wasn't aware of all the details until after the passage. And now as I'm looking and studying it a lot closer and in working with my assessors and even with some of the legislators, I'm getting to know that there's definitely a lot of gray area in this proposition that we need to clean up. And I feel pretty confident that we have the willingness and the support of the legislators to clean up some of the gray area, but there is some, and you're going to hear probably later, especially from the attorneys that'll speak, you're going to hear from them, but there is some changes that we as a board do not have the power to change or reverse because this was a constitutional amendment and it was approved by the voters. So when we get to those questions or concerns, I will address them to the best I can. But at the end of the day, depending on your situation and what we're hearing from the public and especially the realtors, along with the assessors, I think we may need to come up with a follow-up constitutional amendment, which can only take place in a general election, the next one wouldn't be until 2 years out. And I am willing to work with you all on that. As I'm hearing and listening from a lot of the stakeholders, I had a hearing just in our board meeting. We had our board meeting just last week. And one of the days we dedicated just to Prop 19 and then listening to many of the assessors and other stakeholders and the public, it was obvious to me that there's a need to make some changes down the road and possibly to look at some possible language that would come before the voters for another constitutional amendment. But we'll leave that for a later date. Right now, I'm more interested in hearing from you and seeing what we can do as we're crafting this legislative language before the legislators to clean up the gray area in Prop 19. So that's really my principal participation really for this meeting. And I just wanted to thank you and thank my assessor, Jeff Prang, for the invitation. And I'll stick around for the Q&A and willing to discuss whatever I can from my point of view moving forward. Thank you once again.
Great, thank you, Chair Vasquez. Great opening, much appreciated. Now to our main speaker is none other than the Los Angeles County Assessor, Jeff Prang. Assessor Prang was elected as the 27th Assessor for the County of Los Angeles in 2014, and then again by a wide margin in 2018. He served nearly 18 years as a council member for the city of West Hollywood, including 4 terms as mayor, among many other positions in the public sector. Upon taking office in 2014 as the Los Angeles County Assessor, Mr. Prang implemented sweeping reforms to ensure that the strictest ethical guidelines rooted in fairness, accuracy, and integrity would be adhered to in his office. Excuse me. Assessor Prang is a State Board of Equalization licensed appraiser. Please welcome Assessor Prang.
Thank you so much, Meny. Thank you for agreeing to work with us on this very important webinar today. Let me first thank the chairman of the California State Board of Equalization, Antonio Vasquez, for joining us. He's been a great partner in helping us to unravel the many questions and concerns about Prop 19. I'm really thrilled to have 2 experts in the field, Joe Sliskovich, who is a professor of law at Loyola Law School, who specializes in wills and trusts and estate planning, who's going to offer us some insight, as well as Tony Yu, who's an attorney and a CPA specializing in wealth management. So let me start by saying good afternoon. I'm so glad that we have attracted a really good crowd here. We have over 1,000 people who have registered for this webinar. While I'd much rather have this in person, I think we can all agree that we need to stay vigilant and safe and healthy. So hopefully this will work out well for everybody. The purpose of this webinar and others that will follow is to help inform the public about the information and resources that my office offers, whether it be market data to information about tax savings programs. But today we're focused on Proposition 19, and we had to put this together fairly quickly because a lot of people have important questions and decisions to make. The implementation deadlines in the measure have put a lot of pressure on administrators, the county assessors, and the Board of Equalization. We're challenged because there are significant errors and omissions in the measure's language. This means that there's going to be a lack of clear answers and guidance on how Proposition 19 will impact the public and how assessors and the Board of Equalization will be able to administer it. But we want to get the information out there about what we know, also what we don't know, to help make the public help the public make more informed decisions. I do want to say, I actually saw a comment in the chat saying a lot of these questions should have been addressed in writing the measure. Well, assessors had nothing to do with writing this measure. We weren't consulted. This was the idea of the legislature. It's often what happens in ballot measures. Somebody comes up with a good idea, writes the measure, and then they give it to us to figure it out. So we didn't have any role in writing it, but we'll probably be the ones who are going to be held responsible for it if it doesn't work well. So we're committed to making it work well. We've received numerous questions, frankly, an avalanche. It's my goal today to provide you with as much guidance, clarity, and access to resources as we possibly can at this point in time. But please bear in mind that there remain numerous questions that we simply do not have the answers for at this time. Answers that are going to require clarification by the legislature or the Board of Equalization. And as the chairman had indicated, we may have to go back to the ballot because it's a constitutional amendment. Some elements simply can only be changed by ballot measure. But be assured that my fellow 57 other county assessors, the State Board of Equalization, and I are working particularly hard to understand Prop 19 and how to implement it with as little confusion as possible. But I can tell you at this time that many people, quite candidly, will be negatively impacted. The truth is there are simply unavoidable issues in the measure's current language that are beyond my jurisdiction and authority until we get more guidance from the legislature. Proposition 19 is the most significant change to the property tax administration since Proposition 13 was adopted in 1978, and which has been the foundation of the property tax administration in California ever since. Today, our panel of experts and I will do our best to provide you with an overview of Prop 19's impact to the degree that we understand it at this point, absent legislative clarification. We'll also provide additional information about some other factors that to consider when thinking about taking advantage of the provision of Prop 19 as it relates to your family home, inheritance, and finances. But before I go further, let me just give a quick snapshot of my office. A lot of people aren't that familiar with the assessor's office, and I want to just give you a 30-second review. First and foremost, I would be remiss if I didn't let you know up front that I do not send you your property tax bill or collect taxes, which is probably the most common misconception about my office. The guy who collects taxes is intuitively called the tax collector. My office establishes the value. The tax collector is responsible for bills and payments. I'm one of 3 elected officials in the county, with the other 2 being a little bit better known than me. That's the sheriff and the district attorney. And the assessor, in many ways, is the fiscal engine for local government. We determine the value of all taxable property in the county, both real and business property. That in turn is used to calculate property taxes, which in turn provides revenues for local government, including city government, county government, and public schools. I always like to tell my employees that in many ways we are the most important local government agency because no other agency can do its job until we've done ours. And if we don't do our job completely and thoroughly, then property tax revenues that rightfully should be identified and collected are instead left on the table. As you can see on the chart on your screen, the assessor has a symbiotic relationship with several other departments that each own a piece of the property tax administrative system. The primary 2 are the auditor controller as well as the treasurer tax collector. And the way it works is my office receives a copy of a deed from the registrar recorder, or we get a copy of a building permit from the cities. We then complete the assessment of value. The auditor controller is the one who tells you how much you owe. Then the treasurer tax collector mails the bills and collects the payments. LA County Office of Assessor is the largest local property assessment agency in the United States. We have nearly 1,400 employees. We're responsible for valuing over 2.5 million real property parcels and business property assessments in the county, which last year were valued at $1.77 trillion. So at this time, I'm going to yield the floor to Meny, who's going to kind of walk us through the next stage of the presentation.
Thank you, Assessor. Just making sure if you hear me fine. I had some.
I can hear you.
Thank you. Great opening. So, Assessor, you spoke a little bit about Prop 13. For those in this webinar that are not familiar with Prop 13 and how property taxes work in California and your assessments, can you share more about that?
I am happy to. Thank you very much. Good question. There's always confusion about Proposition 13. Prop 13 was adopted in 1978. It was really intended to stabilize property taxes and create a level of predictability in property taxes. Prior to Prop 13, property taxes changed annually with the economy. And if property values were growing really fast, your property taxes grew along with that. And the effect was in the late 1970s, a lot of homeowners, particularly those with fixed incomes, were being priced out of their homes because they could no longer afford the property taxes, even though their homes were generating a lot of equity, but they couldn't afford to pay for that equity. And California's real estate market has been relatively heated for the last 2 generations. Proposition 13 was a constitutional amendment that, generally speaking, it establishes your purchase price as your permanent property tax basis. We refer to that internally as your base year value, or sometimes your Proposition 13 base year value. From the point of a transfer or acquisition, when you acquire your property, the taxable value of your property will never increase by more than 2% a year, which was included in the measure more or less as a cost of living adjustment. Prop 13 also limits your property taxes to 1% of the assessed value at the time of your purchase. So if you purchased your home for $500,000, your taxes will be $5,000. And again, that will not increase more than 2% per year. For our purposes for this webinar, Prop 13 generally means that a reassessment of your property would only occur if there's a change in ownership, such as adding or deleting a name from the deed, or in the event of new construction, such as adding a second story, an ADU, or a pool. Like most ballot propositions, there were a number of unintended consequences that were revealed over the years. With Proposition 13, there have been a number of supplemental measures that were adopted to remedy those consequences, things such as Prop 58, Prop 60, Prop 90, Prop 193. For instance, because Prop 13 requires that a property be reassessed to market value for tax purposes, upon the change in ownership, children inheriting their parents' home and property were often hit with these massive tax increases. So in order to keep the family home and property in the family without being priced out due to skyrocketing property taxes, Proposition 58 was adopted in 1986. And Prop 15 is the measure which is actually being modified by Prop 19. So Proposition 58, the current law for a couple more weeks, allows the primary residence of a parent to be transferred to their children without reassessment. It also allows a transfer from child to parents without reassessment. And we call this, this practice an exclusion, meaning that this transfer is excluded from reassessment, which is normally required under Prop 13. However, it's important to note that exclusion is not automatic. Proposition 50, a Prop 58 claim must be filed timely with the assessor's office. Failure to do so could affect your estate planning. It could result in a supplemental tax bill. Property taxes are calculated on what we call the factored value. And the factored value is simply the base year of your property at the time you acquire it, plus the annual 2% CPI all added in year after year. Although let me add that it's not always a 2% annual increase. For example, this year, it's only going to be 1% because of the impacts of COVID on the real estate market. Also, under current law, parents can also leave an additional $1 million in assessed value of property aside from their residence to their children. But there is no value limitation on the principal residence that they choose to give to their children. However, transfer between legal entities such as corporations and partnerships that are owned by parents do not qualify. Trusts do, legal entities such as an LLC do not. Just to look back for a second, Prop 58 was passed in '86. Never mind, I'm sorry, forgive me. It's an error in my notes. But let me turn it back over to Meny, who I think has some more questions.
Amazing information, Assessor. Thank you so much. That was a good debrief. I heard you mention a lot about market value and assessed value. Can you explain about those a bit more?
This confuses a lot of people. We deal with it almost every day. These concepts are important to know thoroughly and understanding how Prop 19 will affect you. So if you'll indulge me just for a second, let me make sure everybody understands these basic concepts. Market value, also known as fair market value, is what your property is worth on the real estate market today. It's likely what you would be able to sell it for if you hired a realtor like Meny and offered it for sale. Assessed value, it reflects the value of your property at the time of purchase or a transfer. The assessed value of real property is determined by the assessor when you buy it. After we get the deed, we look at your purchase price to see if that is equivalent to market value. Typically it is. The assessed value then becomes your base year value for as long as you own that property, which it also is what determines your property tax bill. As I stated earlier, there's an inflation factor that's capped at 2% a year that's added into your assessed value. And again, your tax rate is based at 1%. So the longer that you own the property, if you purchased your home for example, I purchased a condominium in the year 2000 for $250,000. I sold it 15 years later for $550,000. My market value was $550,000. My assessed value was $250,000. So that the difference really represents your equity in that property. And back to you, Meny.
Thank you, Assessor. Good information as always. Now for the exciting part, can you explain to us what Prop 19 and how it came about?
I often joke as I'm meeting with a lot of different groups, and I had a one-page explanation that just says, I don't know on it, but I'll try to do a little bit better than that for you today. So Proposition 19 passed in the last November election. It was sponsored primarily by the California Association of Realtors. And let me say candidly that despite the relative merits of Prop 19, and there are many, the proposition was really rushed onto the ballot. We've identified subsequently a number of drafting errors and omissions that need to be fixed before I and the other 57 county assessors can administer it properly. But let me tell you a little bit about Prop 19. It has two primary components. The first one I would broadly categorize as the portability of your property tax basis. It allows homeowners who are 55 or older, disabled, or the victims of a natural disaster such as the recent fires to transfer that assessed value or their property tax basis with them when they sell their home and purchase a new one. The second component of Prop 19 places new limits on the inheritance of property tax benefits of a family property. That's why Prop 58 and Prop 193 are impacted. So let me talk briefly about the first component, the portability element. The first component of this measure will allow those eligible homeowners, again, 55 or older, the disabled, or those who are victims of natural disasters, to transfer their assessed value or property tax basis anywhere in the state, including to a home which is more expensive. Current law only allows the transfer of the property tax basis to a home of equal or lesser value, and then only to one of 9 counties. The number of times under Proposition 19 that a property tax basis can be transferred increases from 1 under the current law to 3 for those eligible property owners. We are required by this measure to put this component into effect by April 1st of this year. The other half is probably the one that's generating a little bit more interest and concern. And this will change the rules that apply to transfers between parents and children, or in some cases between grandparents and grandchildren. This is what I believe was intended to be kind of a sweetener in the Proposition 19 campaign to attract more support. It was intended, I believe, to close a loophole that allowed some super rich to evade reassessment of their property in those cases when the property wasn't being used as the family home. However, unintentionally, I'm sure it was written in haste and will very likely have an impact on a greater portion of the population whose assets are connected to property ownership. And I think it'll have a disproportionate impact on middle income folks. As previously stated, current law allows a parent to transfer their primary home of any value and its property tax basis without resulting in a reassessment. The children under current law are not required to occupy the property, even if they choose to use it as a rental. And again, the law also allows you to transfer $1 million in additional property without being reassessed. And that additional property could be rental homes or commercial property. A married couple can transfer up to $2 million. Prop 19 makes significant changes to current law and reduces the property tax benefits when transferring property to children or grandchildren. Here's some of the basic elements of Prop 19 that are necessary to apply for a parent-to-child exclusion from reassessment. 1, the property being transferred must be the primary residence of the parent, or in some cases, the grandparent. No other property can be considered for exclusion of these property tax benefits. The child or the grandchild must make that home their primary residence within 1 year of the transfer. And the inherited base year assessed value does have limits. Currently, the limits are a little bit broader. The more expensive home being transferred to a child, the more likely that the property tax basis will increase for that child when they inherit that property. There's a complex formula that I'm going to have one of my staff members run through as an example of how it works. The implementation of this is coming up very quickly. February 16th is the deadline for this measure. It's extremely aggressive. We're not ready. The clarifying legislation has not been even introduced yet, so this is going to be problematic for us. But I'm going to ask Nicole White-Gamble, who's the Director of Operations here at the Assessor's Office, to explain this formula at this time. Nicole, can you walk us through this, please?
Thank you, Assessor Prang. Yes, so let me just go ahead and walk you through this equation. As noted, for Prop 19, there is a value test that's required. So if the market value of the home exceeds the sum of the taxable value plus $1 million, there will be an adjustment to the taxable value. And we can break this equation down into 2 parts. So the first part, if the fair market value of the family home is less than the sum of the taxable value plus $1 million, then there will be no adjustment. However, if the fair market value of the family home is greater than the amount by which the fair market value exceeds the taxable value and the $1 million, this difference will be added to the trended base value. So it's probably easier if we look at this in terms of an example. So let's say we have a family home and it has a taxable value of $425,738. And then in this instance, both the parent and the child lived in the home, but on March 1st, 2021, the parent dies. The child then applies for the exclusion under Prop 19. And what happens is, because the fair market value of the home is now appraised at $1,750,000, we do a calculation to determine what the benefit will be and what the new assessed value would be. So we have this written in 4 steps. The first step is we want to calculate the sum of the taxable value. We can do this by adding the $425,738 plus $1 million, and that gives us a sum of $1,425,738. The next step is we're going to take the fair market value of the home and we're going to subtract the sum from it. So we take the $1,750,000, which is greater than $425,738, and we calculate the difference. In this instance, the difference is $324,262. So in essence, what happened is the trended base value that currently exists on the home plus the $1 million is exceeding the fair market value by the amount of $324,262. To find out what the new assessment will be, we add this difference plus the current taxable value of $425,738. And the result is that under the exclusion, the child will now be assessed at $750,000.
Thank you, Nicole. Nicole's team has been working very hard on Prop 19 and from the implementation component from our office. This it's not that complicated, but it is kind of complicated. It's going to take some getting used to work your way through this scenario and determining what a new property tax basis will be under Proposition 19. And this screen will be available to you so you can go through some exercises of your own. I did want to offer at this time a word of caution, as I realize that the implementation dates are fast approaching. February 16th for the inheritance component, April 1st for the portability component. But there's many instances when the benefits of transferring property to your children and transferring a property tax basis might actually result in other unintended financial consequences. And we're going to hear in just a moment from a couple of experts who are going to share with you what some of those other tax and financial impacts might be. Meny, back to you.
Assessor, thank you so much. You have provided us with a great foundation, which takes us to the next speaker, as you mentioned.
Meny, before you go on, I actually just looked at the chat, and there was a question that's come up a couple of times, and I want to just address that now. There's a lot of questions, so we're going to only be able to do a few. A few folks are asking, why don't we extend the implementation dates for this? And we would like to extend the implementation dates, but it's been voted on. It's a constitutional amendment, and I have no authority nor jurisdiction in order to extend those dates. I'm not even certain that the legislature does, but if there is going to be an extension, it would have to come from Sacramento. I won't be able to do that, and the Board of Equalization won't be able to do that at the local level. But I'm certainly sympathetic to everybody who's concerned about these fast approaching deadlines. We wouldn't mind having another 6 months ourselves, and if we can get an extension, we will, but it's not on the horizon at this point. Thanks, Meny.
Thank you, and thanks for making that point, because it was definitely a question that was repeating. So I appreciate the insight. So with that, talking about inheritance, etc. We want to know about that, taxes. So I would like to welcome our third speaker, Tony Yu. Tony Yu is an attorney, CPA, certified financial planner, and president at DSG Business Tax and Wealth Planning. Tony is a second-generation owner of his family's wealth planning practice, which his father started in 1986, and is based in Diamond Bar, California, with 17 professional licenses and having previously worked at the largest trust law in wealth protection and succession. Tony is a UCLA Bruin to bring unity, and more importantly, because he found the love of his life, Tony married his wife, a USC Trojan. Tony, welcome. Good to have you. If you can hear me.
Yes, thank you, Meny. Can you hear me, Meny? Your sound was breaking off a little bit here and there. Can you hear me, Meny?
Yes, I apologize for the sound quality. I can hear you fine.
Okay.
First question for you, Tony. Some people are asking, if I transfer my property to my children now, what other tax consequences do I need to be aware of? Can you walk us through that?
Yes, definitely. Thank you, Meny, first of all, for the introduction, and thank you, Assessor Prang, for the opportunity to speak to our fellow LA community citizens. This is a very complicated question, and I'm happy to help as best as I can. So, can we go to the next screen? All right. So the topic today is Prop 19 and property tax, and so my task is to share with our friends in the community that there are other multidimensional considerations that we need to think about. And this is relating to income tax, gift tax, estate tax. So there's multiple taxes. So my task today is just to discuss that, as much as we are honing in on just the property tax, we need to take a step back, because there's other impacts that will be created if sometimes we just look at the trees and miss the forest. And so the other complications are income tax, gift tax, and estate tax. So can I get the next screen, please? All right, so the income tax. So one of the biggest things that we have to consider now is if we transfer the property, what happens now if we do a lifetime transfer? So the bottom line at a very high level is the give and take concept of, do we hurry up and gift the asset away now before February 16th? But what do we give up? What's the concession? What do we lose in exchange? And the biggest thing from an income tax perspective is the ability to step up your tax bases. So there is a federal tax rule that says if the parents keep the asset on hand upon death, the asset that they have on hand will get a step up in tax bases. And that's very, very important. That's not something to easily just give up. Because, for example, if the parents purchase a property for $10,000, and upon the date of death, the market value of that property is $1 million. Well, upon the date of death of the parents, when they pass it on to their children, the new tax basis will become $1 million. So if the children were to sell the property the next day, there will be $0 capital gain. Okay, so zero gain. So it's no more income tax. So as much as right now we're honing in on property tax, the 1% of property tax, don't forget the 20% of capital gain issues that's down the road. So so that's the biggest concept, is don't forget about the step up in tax basis, the income tax issue. So one of the consideration is how likely are your children going to sell this property? So if the children is going to keep the property for a long time and meet all the rules of Prop 19, and if you preserve this tax basis and keep it on going forward, then it's worth it. But if the children are going to be immediately selling this thing next day, well, then the step up in tax basis is much more critical. And so this is something that you need to discuss with your professional CPA lawyer, to discuss the pros and cons of making a lifetime transfer now, try to beat Prop 19 deadline, but don't forget about this income tax. So on the screen it says if child is likely to sell the property, well then you got to preserve the step-up tax basis. So don't just easily give it away right now. Could consider holding it. If the child is likely to keep the property, then yeah, maintaining your tax basis very long time will be important. And then you got to consider, well then if you keep this property, if you don't give it away, and then the children inherit it, well then are they gonna be keeping as a principal residence, because that's one of the requirements of Prop 19. And are they going to be converting this? Because if they convert under the new rules, then there'll be another tax trigger. And so again, the bottom line of this message is step up tax basis for income tax versus preserving your property tax base. Next slide, please. All right, so we wanted to do a numerical discussion of this topic. My assumption here is the parent's primary residence. It's their primary residence for now. They filed a homeowner exemption on it. So on paper, it's clearly a primary residence. And the assumption is the child will make the property his primary residence after they inherit it. And so if the tax base, the property tax base is $500,000, we'll also assume a income tax basis of $500,000. So these are assumptions going forward on this slide. So assuming at the time of transfer is $1.3 million, that's the fair market value. So income tax basis 500,000, the property tax basis assessed value of 500,000, and $1.3 million for a fair market value time of transfer. Okay, so then from a property tax basis perspective, what we will have to look at is that the formula that Assessor Prang's office just discussed is, well, let's look at the differential. So 1.3 minus, so you have your $1.3 million minus $500,000 will be $800,000. Is the $800,000 over the $1 million? So the answer is no. So there'll be no reassessment upon transfer. So the tax basis will remain the same at 500,000. Okay, so then if the child were to get the property now, and then there's a capital gain, so then the $1.3 million, if they're to sell it, there will be $800,000 capital gain, $800,000 capital gain. And if the child were to wait 2 years after inheriting it, then they can use the federal tax allowance of $250,000 of avoiding gain on sale for a primary home. And so this will be a capital gain of $550,000 at, in the best case scenario. So this is just running through really quick. If you were to sell it, how much you lose out on a capital gain issue. Can I get the next slide, please? Okay, so in this situation, let's say the parent does not transfer, and sorry, let me back up 1 second. And so when you do a lifetime gift, there is a very important accounting concept, is that the basis carries over, basis of the parents. And that's why in the earlier slide, when you do a lifetime gift, the basis carries over. So the basis of the $500,000 carry, whatever that number was, it will carry forward. And so when the child eventually sells it, that they will use the parent's basis. And so in this example on this slide, the parent does not transfer the property to the child, okay? So when the property does not transfer, so basically they're inheriting it upon death, this is where we talked about where there is a step up in tax basis upon death of the parent. So in that situation, the basis stepped up to the fair market value. So you see in the middle of the screen, the capital gain will be 0 because the fair market value will be 1.3. And the basis will be stepped up upon to the parent's date of death value, which would be 1.3, and the children have 0 capital gain. Okay, and in this situation, based on our earlier assumptions, there is no change in property tax because the child moves into the property, uses principal residence, and there's that $1 million allowance that we talked about from assessed value to fair market value if it's below $1 million. So under there, Prop 19, it also satisfies, so there's no step up in property tax basis. If the child does not use the home as principal residence, then the property tax will be reassessed to market value, which would be 1.3. So earlier we just talked about income tax, and the overriding point there is that don't forget your step-up in basis. Do you want to hold it now or do you want to gift it away? So that's income tax. So if you do want to make a lifetime gift, then there's another dimension that you have to consider is how much can you give? And so there's an annual exclusion amount per donee. Okay, so so mom and dad can each give to their child A, $15,000 each, and so together that child A can receive $30,000 in total from the two parents. So the annual exemption amount is per donee, not per donor. Okay, so that's something that the IRS allows us to gift on an annual basis. So in addition to the annual exclusion, sorry, I can't go back to the last slide. There's a lifetime exemption amount. This is how much you can gift in your whole lifetime. And this exemption amount is very critical because it's tied together with estate taxes as well. So your whole lifetime, whether it's lifetime giving or giving upon death, the transfer upon death, your total right now is $11.7 million, okay? So once you tap out of your annual exclusion, you still have the ability to gift $11.7 million per person. This is donor, okay, donor. No matter who they give it to, the total that they can disperse out would be $11.7 million. And husband and wife together is $23.4 million. So again, taking a step back from income tax perspective, got to think, do we give it now, give it later? Do we give up the step up in tax basis for income tax purposes? So if you say, okay, I want to give now, what are the limitations, what are the restrictions? Then it comes to gift tax, and the gift tax is $15,000 per year per donee. Or you can say your lifetime exemption is the 11.7 million. And the form you file related to that is 709. That is the form that report to the IRS that you're using up a gift tax exemption amount. And anything above this lifetime exemption and annual exemption amount would be taxed at 40% for gift tax purposes. Next slide, please. All right, so in this is a gift tax example. So earlier in our same fact pattern, the parent decides to gift to the child. You report on a 709, and the gift, the fair market value is $1.3 million. So you can take off your annual exclusion, which is $15,000. Here is a very simplified formula. I mean, you can do this thing called a split gift from mom and dad. So you could apply multiple, you can do annual exclusion that's double. And then you can, reduce each parent's lifetime exemption amount. But here, a very simple formula, straightforward example is reduce it by the annual exclusion for one parent. Then you got your taxable gift will be, 1.3 minus 15,000, which is 1285. Then you will just reduce that from your lifetime exemption amount, which is 11.7 minus 1285. So that 10,415,000 will be your remaining lifetime exemption amount. And then the gift tax is zero because you're using your exemption amount. A word of an extra tidbit here is the exemption amount is expected to change, to be reduced at the end of 2025. So starting 2026, the exemption amount, your lifetime exemption amount, is expected to go down to $6 million, depending on cost of living adjustments. So around that ballpark. There's also another external force, which is the new administration is the tax policy projected is supposed to be reducing, they're designed to reduce exemption amount even further lower to possibly 3 million or 4 million. So again, right now, today is 11.7. If there's no changes at all, it is going to be reduced to about half, about $6 million at the end of 2025. And if there's any further government changes, it's projected to be reduced down to 3 or 4. So this is something, additional tidbit I want to share with everybody. Next screen, please. Okay, so for estate tax, so income tax, gift tax, and then now estate tax. So if the parents hold on to the property and pass it to their children, their heirs upon death, then we have to think about income as estate tax. So again, the amount is 11.7 million. Anything above 11.7 million per parent, it will be taxed at 40% estate tax. And this is something I mentioned earlier about the being reduced in half on January 1st, 2026. The form that needs to be filed for all estate taxes is 706. Some additional tidbits here is that 706 usually does not need to be filed for estates that are below the exemption amount. But if you want to maintain a flexibility and use this tax wording called portability, portability is basically allowing the surviving spouse to use the first to die decedent's exemption amount in the future. So you portability, you carry over to upon the second spouse's death. If you want to maintain that flexibility, then the government requires us to file 706 upon the first spouse's death in order to have the ability to port and use the portability exemption upon a second spouse's death. So this is estate tax. So this would be the, if we're going down, forks down a road, the logic forks down a road. This is where, okay, I don't give away now for property tax considerations, but for estate tax, I'm going to be keeping on hand, and this is the things I got to deal with down the road when the parents pass. Next slide, please. So the bottom line is don't just lose sight of the bigger picture. Discuss with your professional team. I know property tax, some of the numbers are very, very large from assessed value to fair market value. So there's definitely something that everybody should be thinking about, but just don't forget about the capital gains taxes, other taxes, the income taxes, the gift taxes, the estate taxes. It's all multidimensional, but it's interdependent, and it'll cause dominoes to fall once you make a decision one way or the other. Next part is review your estate plan. Things may have changed, assets may have been brought in, assets may be owned by LLCs, etc. So definitely talk to your trust attorney to update your plan, especially if you do intend to make any lifetime gifts right now. The next thing is non-tax consequences of transferring property. So I had spoken about all these tax considerations, but there's other factors you got to think about. On a screen, it talks about responsibility. Are the children ready to receive this property? If you want to give them a primary home right now, that's $10 million. But there's also, in my experience, other things that happens. For example, how about the parents' ability to retire and count on their own retirement funds and their own welfare? Sometimes our clients are so stuck on just the numbers and the law, they forget about financial planning or general thoughts about their own well-being. They just want to minimize taxes everywhere. And I've had dealt with cases where the parents gave assets to the kids at an earlier age, and then the child gets married, and then for different reasons, they kind of turn on the parents and don't give them money in the future. And I've had clients come in and cry about it and say, what happened to my child? They're supposed to be cooperative, take care of me, but then on paper they own nothing anymore because they transferred everything away. So you got to consider, I think the primary is to consider the parents' own retirement and well-being. So that's very, very critical. And then just then you got to think about other things. For example, if you transferred away, is the child going to be responsible? Do you want to subject this asset to the child's marriage situation? What if they get a divorce? Do you want to subject to that? Or business liability? Do you want the child to own this asset, this $10 million home that you transfer for property tax purposes, and the child is maybe gets in a lawsuit for business reasons? So these are non-tax consequences that are just as important as the income, estate, and gift tax consideration. So that's something I just want to share with you. The bottom line message: consult with your advisor. Just every situation is different, so please talk to your advisor about that. So then the low property tax base is current market value. The critical thing is, yes, you can preserve this property tax if you do it right, if you do it before February 16th. But the other things to consider is, well, are your child really going to keep this for a long term, right? Because the benefit is they'll keep it, and then they can keep that low assessed value for many, many, many decades, right? But you know, to be very frank, many of my succession plans that I've dealt with, the child, they don't want to deal with real estate. They don't want to deal with fixing the tenants' plumbing issues or rental issues, etc. So sometimes many times they just fire sell it upon the parent's death. So you got to really consider: do I want to go through all this trouble to for property tax reasons? But then are they going to retain it for a long term? So vacation home typically does stay on hand for a long time. There's a lot of times it's not rented out, so there's no headaches for the children to take over this property in the future. And no plans to keep property after death of parents. That's, like I said, that's many situations. Rental property. Do the children plan to take this very expensive home and rent it out? Well, under Prop 19, if you rent it out, well, that's going to trigger reassessment. The intention of the primary home is changed. And how is estate allocated amongst family members? So this is something you got to think about. Who's going to be receiving it, et cetera. If this is under LLC, is going to be a different change in control that would affect other triggers. So at the end of the day, my message is it's multidimensional, many things to consider. Deciding on one path will have effect on other parts of your plan. And so please, speak to your professional advisors and come up with a plan, because every situation is very, very different. Thank you.
Thank you, Tony. Wow, that's a lot to think about. I definitely know what I'm going to dream about tonight for sure. Another thing is the assessor's office has received numerous questions about trust and estate planning. And to help us understand about trust and estates, I would like to welcome our fourth speaker, Professor Joe Sliskovich. Professor Sliskovich is a member of the California Bar, received an LLM in taxation from NYU, a JD from Loyola Law School, Los Angeles, and a BA from the University of Southern California. After practicing tax law in California, Professor Sliskovich joined the faculty of Loyola, where his primary areas of interest are taxation and trust and wills. Professor Sliskovich has taught courses in individual income tax, corporate tax, partnership tax, business and tax planning, a seminar in advanced corporate tax planning, and trust and wills. Professor Sliskovich has been an instructor with Barbary, where he lectured on the topics of wills and trusts, preparing students to take the California bar exam. He has acted as an expert witness in complex tax and estates litigation, and has been recognized for his teaching, receiving Loyola Excellence in Teaching Award. Professor Joe, good to have you on this session. If you can unmute yourself, I'm going to ask you first question. Many people are asking questions about Prop 19 and trusts. Does Prop 19 affect real property held in a revocable trust?
Well, thank you, Meny, and thank you also to Tony and to Assessor Prang for doing the heavy lifting and setting forth the primary issues and analysis that a family should consider in determining whether or not to transfer property to the next generation. The interplay of the various tax systems, property tax, income tax, gift tax, and estate tax, they make the decision to transfer property to your child far more complex, while ignoring the non-tax issues can result in unanticipated and potentially disastrous consequences, as Tony mentioned. Two small points before we get into the specific question, and just to build on Tony's presentation. The interplay between the stepped up basis on death and the carried over assessment tax basis for property tax is very important. And there's one additional issue that should be considered as part of this discussion, and that is the depreciation advantage that the family, the successors, your children may get on having the property stepped up in value and basis for tax purposes, may be generating depreciation deductions for them well into the future that in many respects would reduce, if not offset, any property tax savings that they might enjoy. And this is, again, very fact specific. It depends entirely on your circumstances. And you should speak to your tax advisor to determine if this is something that you should factor in. And secondly, as you pointed out, Tony, the new administration has its eye on eliminating or reducing significantly the current credit against the federal estate tax and gift tax. Another target that has also been mentioned is the stepped up basis. So it may be that that too will be eliminated in coming legislation. We don't know. We'll keep our eyes open for it, but understand that this is a moving target and we really have no way of anticipating where it will come to rest. So now on to your question, Meny. Does Proposition 19 affect real property held in a revocable trust? Well, the answer is that a revocable trust does not shield you from the legal effects of Proposition 19. This question comes up a lot. Clients often believe that by setting up and funding a revocable or living trust during their lifetime, they've taken care of the transfer of that property following their death, and that there's nothing more that needs to be done. Well, unfortunately, they're often mistaken. So let me take a moment for those that may not be familiar with revocable trusts to lay out some of the benefits and limitations of this fundamental estate planning device. First and foremost, a revocable trust by its terms can be amended, modified, or revoked in its entirety, which means that the grantor, the person establishing the trust, can get the assets back from the trust if they choose to do so at any time and for any reason. Now, revocable trusts, therefore, are viewed as will substitutes. And what that means is that the property that's been placed into the revocable trust while you are alive will pass to the named beneficiaries in that trust upon your death without having to go to probate. And that's a significant advantage, avoiding the cost and delay that probate entails. Now, since the grantor can get the property back, a revocable trust is not viewed as a separate entity, but rather an extension of the individual grantor. It's a tax transparent transfer for all purposes. So, for example, in reporting income from the revocable trust, the trust itself does not have a tax ID number. Rather, the trust will report income using the social security number of the grantor who will pay tax. Now, as a result, placing assets into a revocable trust does not trigger a change in ownership for property tax purposes. The reason for this is that no beneficial interest has been transferred by the grantor to the beneficiary or beneficiaries named in the trust. However, on the death of the grantor, a change in ownership does occur when the beneficial interest of the beneficiary matures. So as a result, the grantors, for grantors dying after February 15th, Proposition 19 will apply. For grantors dying prior to February 16th, the existing rules continue to apply. Now, let's contrast this treatment, this result, to that which occurs when the use of an irrevocable trust is brought into play. Now, what is an irrevocable trust? Well, an irrevocable trust is one that, by its terms, cannot be modified, amended, or revoked once it's established. Accordingly, transfers to an irrevocable trust will be deemed to pass the grantor's beneficial ownership interest in that property to the beneficiary named in the trust, triggering a change of ownership. So, for example, some estate planners are setting up irrevocable trusts for children, often for minor children, prior to the February 15th effective date, February 16th effective date of Proposition 19, hoping to lock in the provisions of the current law. But note, with a revocable trust, the grantor parent does not give up control of the property, while with an irrevocable trust, there is a transfer of control, carrying with it the potential for all of those unpleasant consequences that Tony raised. Now, many estate planning professionals are suggesting that as part of this plan to use an irrevocable trust, the parent reserve a right, such as a right to change beneficiaries to anyone other than themselves, in order to cause the property in that trust to be included in the estate of the parent for estate tax purposes under Section 2036 of the Internal Revenue Code. The goal of this arrangement is to lock in the property tax assessment basis while potentially securing a stepped up basis for income tax purposes through the inclusion of that property in the estate of the deceased parent. Now, this would look like the best of both worlds, certainly in theory. Well, not all estate planners are in agreement that this arrangement will succeed. But if you are interested in getting more information on this or other planning opportunities that may be available to you, you should speak to an estate planning professional to determine if this type of technique makes sense in your case. Meny?
Thank you, Professor, for giving us that breakdown. That was very thorough. Many people, get confused between the two. Another question: how does Prop 19 affect revocable transfer on death deeds?
Well, let's take a few minutes first to identify just exactly what we're talking about. What is a revocable transfer on death deed? Well, as the name suggests, it's a deed revocable by the transferor at any time prior to death. This is a relatively new tool that California residents have available to them for their use in transferring property on death without having to go to probate court. The revocable transfer on death deed is similar to a beneficiary designation on an insurance policy or to an investment account. You identify by deed who should get the property when you die. Now, the transferor continues to own the property and to control the property until they die, at which time the designated beneficiary becomes the new owner of the property. So a key point here: the deed can be revoked by the transferor at any time for any reason prior to death by filing the appropriate form with the county recorder. Now, on the death of the transferor, the named beneficiary needs to record evidence of the death of the transferor and file a change of ownership notice. Now, because a revocable transfer on death deed does not become effective until the death of the transferor, the transfer of beneficial ownership of the property does not occur until after the transferor's death. Thus, as was the case with the revocable trust, a transferor using a revocable transfer on death deed does not constitute a change in ownership and does not affect the legal impact of Prop 19. Now, so as a final aside, the original effective date of the legislation creating the revocable transfer on death deed was set to expire on January 1st of 2021. However, that effective date was extended by further legislation to January 1st of 2022, which means that any recorded transfer on death deed filed prior to January 1st of 2022 will continue to be effective, but no new revocable transfer on death deeds can be filed after that date. And we will, of course, see if the legislature extends this provision further. So again, if you are interested in getting more information on this or other planning opportunities that may be available to you, you should speak to an estate planning professional to determine if this type of technique or others may suit your particular case. Back to you, Meny.
Professor Sliskovich, thank you so much for that great information. And to those who are watching us live, with over 1,000 viewers, we can't get all the questions, but please submit them in the Q&A section, and Assessor Prang's office will reach out to you and answer to the best of their ability. Now, Assessor, you back with us again. A few questions that have been submitted prior to this afternoon that we got. The first one, if my parents transfer their non-principal residence to me prior to February 16th, 2021, would it still qualify for the parent to child exclusion under previous provision, Prop 58?
Yes, you will still qualify under Prop 58 because Proposition 58 is in effect until February the 16th. So if that transaction takes place and is prior to the implementation date, the previous law will go into effect. Prop 19 will take place starting on the 16th. So yes, you can transfer that property prior to that date. Although today's the 22nd of January, that date's approaching very, very quickly.
Yeah, thank you for that answer, Assessor. Another question that came about is, do I have to claim the homeowner's exemption to qualify for the parent-child and grandchild exclusion?
You do have to file those claims. They are not automatic. In fact, this is one of our biggest public service challenges. A lot of folks know that you can inherit property from your parents, in some cases your grandparents. If a form is not submitted to us, we don't know that happened, and you will get a supplemental tax bill.
Thank you, Assessor. Next question. If the property transferred to 3 children, do all of the children need to reside in the property in order to qualify for the exclusion?
This is one of the areas I like to highlight in talking about some of the deficiencies in Proposition 19 because it's problematic. So a strict reading of Proposition 19 says that if you as a parent, let's say you have four adult children with kids of their own, and you want them collectively to inherit your property, Prop 19 says that all 4 of them have to move back into the family home in order to take advantage of those property tax benefits. Obviously, that's absurd, but that's what the law says. And I'm not a policymaker. I don't have the authority to do anything other than what the law says. So we are looking for clarification from the legislature in order to clarify this point. We are confident that the intent was that one of the 4 members of the family would have to live in that property to meet the terms. That is the way that we will enforce it, even though there is not legislation that confirms that point. But this speaks to the many deficiencies in the language that we're going to have to grapple with over the coming months.
Thank you, Assessor. On your screen, you will see many legislative questions the Assessor's office is asking. Nicole or Assessor Prang, can you please explain?
So yes, one of the things that we've been doing over the last couple of months since Election Day is trying to figure out what those deficiencies in Proposition 19 are. My office has written a fairly extensive legislative package that we're trying to get introduced at the legislature that will help us clarify a number of these measures. But I wanted to just give you this visual of the dozens of questions that we don't have answers to that are essential for us in order to administer Proposition 19. Most of this is going to require legislative action. Even if we get this bill introduced in this legislative session, it will take months before it is passed and signed into law by the governor, which means that it's going to be fairly chaotic with a lot of provisions of Prop 19 over the next couple of months until this legislation is done. What I can tell you, I'm sure that the Chairman Vasquez and the Board of Equalization will support this, we are going to do the best that we can do to interpret the intent of Prop 19. We're very cognizant that a lot of people could be negatively impacted by some of the provisions until the legislation is done. But we're going to make our best guess and hopefully come up with some interim solutions that will be ratified later on by legislative action.
Thank you for those answers, Assessor. Seeing we are running somewhat out of time, so whoever's watching us live right now, please submit all the questions in the Q&A box. And once again, the Assessor's Office will get to them soon. Some important dates, deadlines to consider. Not sure if you can see it on the next screen, Robert. Parent-child transfers, Prop 58. Grandparent-grandchild transfers, Prop 193, effective February 16th, 2021. And senior citizen and disaster relief tax base, effective April 1st, 2021. For any Prop 19 assistance and guide and questions, please call the Assessor's Office at 213-974-3441. Once again, that was 213-974-3441. Or you can email oservices, OSERVICES @assessor.lacounty.gov and PIO@assessor.lacounty.gov. For general public service, please email helpdesk@assessor.lacounty.gov. And always visit the Assessor's Prop 19 website at assessor.lacounty.gov/prop19. Once again, that's assessor.lacounty.gov/prop19. There you can find a lot of available information, fact sheets, and FAQs, and a recording of this webinar as well. Also, subscribe to Assessor's Prang's newsletter at assessor.lacounty.gov, where he will be sending out information about Prop 19 on a regular basis. With that, I would like to thank California BOE Chairman Vasquez for joining us, Assessor Prang, Tony Yu, and Professor Sliskovich for their valuable insight. I'm sure that this is only the first out of many. So thanks everybody for joining us. Assessor Prang, thank you so much for your time and insight.
Thank you very much, Meny. I want to thank everybody for joining us. Hope this webinar was informative. We'll be doing more as based on what we learned from this one. And please keep your questions coming. We will answer those, and we'll post as many as we can on our website so that you can learn from other people's inquiries going forward.
Thanks, everybody. Thank you so much.
Thank you.
Thank you, everyone.